In the previous topic, we learnt about the cycle that a business goes through in terms of purchasing their products, selling them to the consumer, and how the profit is generally calculated. Very basic, of course, because at this stage, that's generally all you need to know. But now we need to find out, how do we actually record and document these transactions? In bookkeeping and accounting, there's a lot of terminology. For this topic, we'll only deal with terminology applicable to the different scenarios. The purchase journal is the book where a business records all goods purchased on credit. The sales journal is a book where a business records all goods sold on credit. And petty cash is the money which is kept for small things, for instance milk, newspapers, stationery, any odd things that need to be bought on a daily basis. Cash book is a book where businesses record all monies received or banked and all monies paid out. The ledger is a principal book where we summarize all that we have done in books of prime entry. Let's just differentiate between accounting and bookkeeping. Accounting is the art of recording transactions of the businesses into books of accounts. Bookkeeping, on the other hand, is a term given to the recording and tracking of basic finances, for instance, income and expenses. Businesses almost always start on borrowed money, whether it's from the bank, the owner's own pocket, investors, sponsors, whatever the case may be. This would mean that everything a business owns is equal to the value of everything it owes. It is simply two aspects, the giving of a value and a receiving of an equal value. This leads to transacting and the method of recording. These transactions are the duality of bookkeeping, as one account in the books is debited and the other is credited. Now, before we move on to the books as such and how we actually enter into these books and what it actually is, let's first just differentiate between a creditor and a debtor. A creditor is the person who owes money to, and a debtor is the person to whom money is owed. So this will all depend on if somebody owes you money or if you owe them money. If you owe them money, you are their creditor. If somebody owes you money, if they owe you money, then you are the debtor. So if you've sent out an invoice, you are the debtor, they are the creditor. If they've sent an invoice to you, you become the creditor and they are the debtor. If you have a look at the examples of the tables that you see in front of you, that is exactly the way ledgers need to look and the way creditors' journals are looked. They have specific size columns, they have specific columns that are in them. It doesn't change for any different bookkeeping. Let's take a look at double entry bookkeeping. It is simply the concept of debiting one account while crediting another. If we buy stationery from Walton's, the stationery account in the ledger is debited and the creditor's journal is credited. The recording of these transactions is done in journals. Purchase journals, sales returns, cash book, petty cash, debtor's journal, creditor's journal. All those journals are the journals that are used. Dependent on the transaction that's done, it needs to be recorded in a typical book. It is important to remember that the method of transaction, either done on credit or cash, will also determine the accounts that are debited and or credited. For instance, if the money was paid cash to Walton's, the cash received journal would have been debited with that amount. Luckily, today we have systems that transact for us. However, the human element is still required to do the initial input and check that the system is performing correctly. Laser scanners that scan items when we purchase goods, this is processed into the system and will automatically allocate the amount to the correct account. In corporate cases, money is paid to service providers and or creditors via EFT. If we take a look at a double entry system, the goods sold, system allocates to sales journal, the bank account is credited, the money is received from the source. When we purchase goods, the system allocates to the creditor's journal, the bank account is debited, and the EFT payment is done. The secondary book of accounts are called ledgers. Transactions from journals are entered into the ledgers. General ledger, debtors, creditors, fixed asset registers. The recording of these transactions is called posting. The account is in a T form, hence T account. It has a credit side and a debit side. If we have a look at the example there, we bought stationery from Walton's. It was added to the creditor's journal because Walton becomes our creditor, and then we need to record it in the general ledger, and there will be a debit and a credit. We bought stuff, so it will be debited. Only when we actually make a payment to Walton's and it goes out of the bank account will it go into the credit side of the general ledger. Source documents are documents that are used to make entries into the books. No entry should ever be made without the necessary documents. Some types of documents, like invoices for instance, must have certain information which is prescribed by law for tax purposes. Other documents may not be as strict depending on the nature and type of document. Make sure that whichever document you're working with, that they comply with all the legal requirements. Documents like delivery notes, quotations to process purchase orders, receipts, petrol slips, cash register slips, petty cash vouchers, bank statements are all types of source documents. You may come across other source documents in your organization depending on the bookkeeping system that you're working on. The process of transactions and documents produced for the specific transactions may look as follows. The retailer orders goods, issues a purchase order, sends it to the manufacturer, who is then the debtor. The debtor delivers the goods with a delivery note and issues an invoice for the goods purchased. Both parties record the transactions in the relevant book accounts and monitor their bank account, one for the debit and other for the credit. When an organization purchases goods on credit, a statement of accounts is issued at the end of the month. This statement will include the date of all the invoices that were issued throughout the month, the amounts of the invoices, the date of the statements, as well as any payments that were received within that particular month, with a balance indicating how much the organization still owes. Payment arrangements are made. As soon as the payment is received, it is then recorded in the debtor's journal and the general ledger updated. On a monthly basis, a bank statement must be drawn and all amounts received and or paid should be recorded in the relevant journals and or general ledger. This is known as reconciling the bank account. Now, earlier we did a transaction for trading or for XYZ trading. We bought stationery from them and that was recorded in the debit side of the general ledger. Then we drew a bank statement. The bank statement showed an EFT payment was made to XYZ. The credit side of XYZ in the general ledger is then credited because now we don't owe them anything anymore, and the bank in the accounts is then debited. Now remember, earlier I mentioned that no documents or no payments should be made without documents. Payments should only be made against documentation. An invoice, a statement, and must be recorded accurately. Always make sure that all transactions are recorded accurately. No payment should be received and or made without the relevant documentation. And that's a wrap for topic 2, basic bookkeeping. Bookkeeping is the term given to the tracking and recording of finance documents. A debtor is a person, organization to whom money is owed. A creditor is a person, organization that owes money to. All documents must be recorded in the relevant accounts or journals, and payments must only be made with the relevant documentation.